to take a schedule.
Hard to follow Tammy, so, but I'll do the best I can, right? All right, well, let's see. Well, so I've met everybody today already. I'm Chris Whalen, CPA, and I have a full-service CPA firm in the Red Bank area. Everyone pretty much knows that. I do a lot of work with real estate agents and brokers, investment property strategies, tax benefit analysis, 1031s, and we do all of the standard other things a CPA firm would do, especially for business owners. My main thing to remember here is if we aren't working for you, then you aren't working at your best. You're almost there. You just need to have me to get 100%. So make sure you hire me before I leave today. We're going to be talking about an income tax and business update for real estate agents and brokers. And first thing is cell phone rules. I always say the first thing that was invented after the cell phone are cell phone rules for meetings. And so I have different rules though. I want you to make sure that you turn your ringer up as loud as you possibly can so you can hear it. Because any call that you get is much more important than what I'm saying. When I see adults scrambling to turn up their phone, it gets me very upset. So, because if I get a call, I take it, because that's usually a client on the phone, and you're not a paying client yet, so everyone would understand, right? So we're going to be talking about the Trump's new tax plan and how it affects real estate agents and their clients. And so the main thing is some of you think about the president like this, some of you think of him like this. I don't care, I'm nonpartisan, how does it affect us at the street level? That's all I care about. So now I might have triggered people with saying Trump, so we need a safe space. There's some teddy bears in the back in a room with some cupcakes. That's the case. I don't want anybody upset. So everyone here, real estate agents, know this is a Moody's article that President Trump's plan will soon hit New Jersey homeowners hard in ways they don't expect. And it said in the article that it's going to leave many taxpayers with less disposable income and wealth and less money for a house. It's going to cause housing prices to drop. Right? And we've heard that over and over again. But we all know that's fake news. It's 100% fake news because everything in it is baseless with no analysis. It never shows anything. And this is not, I'm not guessing, we have the law. Well, how does it affect people? And that's what I do. And so our job as professionals, especially you, bless you, is to educate, right? If we do that, our sales will increase, right? The market's the market outside the door. If we're the most educated and exude the most confidence, we're going to get more listings than anybody, right? So your clients have questions, right? You're not a tax expert, yet you get them. And sometimes, even in my world, we all can overextend ourselves in someone else's discipline, right? You don't want to act like you don't know the answer, especially there's a lot of nervousness out there in the market, right? So how should you handle it? What should you do? Well, the main thing you want to say is my selling point number one for you is a seasoned CPA can analyze the impact for you. If you don't have one, please let me refer one named Chris Whalen. So that's the most important advice of the day. But honestly, it's that, well, you should know enough, but say, well, I don't know specifically, ask a CPA, right? And he can analyze it for you. And my job is to, in this market with this fear, is I'm just here to be the bridge to get them over the tax hump. And then you guys can go back to selling houses for all those good, flowery reasons, countertops and schools and all that, cul-de-sacs and all that jargon, right? But honestly, that's really the reason I'm here for you. All my agents know I'm on call for them, and sometimes you don't have someone to call who readily gets back to you, and that can make you look bad, where I'm pretty responsive to all the real estate agents' needs. Now this is really something that you can say because this is true. Since the new laws were passed, I worked closely with my CPA analyzing many scenarios. We found very few there was a negative tax consequence. That's true. 95% of the returns I do across all strata, from 20-year-olds to 80-year-olds, 95% are doing better with the new law, with deductions lost and everything. So it's very important to remember, the thing is, agents should have a lot of confidence in selling. It's very important. And also mortgage, I talk about mortgage rates going up, which Tammy alluded to, and I talk about that a little bit too, which is important. All right, so this is the most important slide of the day for real estate agents. Many families will have more after-tax income in 2018. You should be selling higher-priced homes and more of them. We like that, right? That's why brokers have me in. Say this, but that's true. That should be, honestly, if you analyze it and just get a look at the numbers, people can afford more of a house. I go through some good case studies here. You're going to see exactly how it really works with your potential clients from a tax perspective, so you get an idea of what I'm talking about. So let's go over some of the significant tax changes that are going to affect us personally, but also could affect our potential clients, okay? So everyone has heard of the child tax credit, and it used to be $1,000 per child. Now it's $2,000 per child if they're under 17 at the end of the year, right? But what's happened is the income phase outs are higher. So traditionally, a family that has a child, if they have made more than $110,000, they don't get a child tax credit. So that's not even a middle income, right? So now that's changed to a married couple making $400,000. You're going to see in our examples how that makes a big difference. So imagine now how many more families are going to have a child tax credit that never did. So that's a very important thing to consider when you guys are thinking of, after-tax income, right? If you're looking at a client with 2017 numbers, even trying to apply 2018, well, if you see a few kids on their tax return and they're underneath the 400,000 but over the 110, you should be thinking, hey, they're going to have more discretionary income because they have this newly found child tax credit, right? Very important. The next thing, itemized deductions. What can happen to them? This is our big fear. Everyone's worried about the other specific deductions. So let's go into mortgage interest because this has changed a little bit, and Tammy can verify it, hopefully. So traditionally, if a loan amount of a mortgage is over $1 million, I couldn't take that portion of the interest, right? If I have a mortgage that's $2 million, if I have $20,000 of interest, I can only take $10,000. Understand that? Because I couldn't take the prorated portion, right? So loans prior to 2018, they're still deductible up to $1 million, but any loans after that, currently in 2019 or after 2017, that number goes down to $750, right? On new loans. So if I have $1 million loan with $10,000 in mortgage interest, I can only take $7,500. Make sense to everybody? Now that doesn't affect everyone, but I just go back that there's a lot of jumbos out there, and this affects jumbos. But even selling the mortgages to my clients, so let's say someone says, wait a second, yesterday I could have gotten the deduction for the $1 million. Now I'm only getting $750. And so, but so I say still get the larger loan because I want to do other things without money because the money's still cheap, even without the deduction. That's the answer? Okay, just checking. That's my answer. So mortgage rates are increasing. We just heard it, right? So it goes right along with what you said. But another home buyer worry. But as you'll see, tax savings can offset this. I don't care if I have an extra 3/4 of a point over last year, because some of the savings could even that out, which is an important selling tool. People worry about this. Like that's my mortgage rep's idea with, well, wait, we need to know. Right after tax, I could easily offset a 0.5 point from last year to this year, and people don't think of that. So I'm trying to give you ways to answer questions you're going to get ahead of time. I like to have all the answers ahead of time so everyone signs on the dotted line and let me go to lunch, right? So home equity loans, very important. HELOCs are mostly disallowed now in 2018. Even if it was gotten before 2018. It's not grandfathered in. So it's very, very important. The assumption has to be it's not deductible. But there is an exception if it's for acquisition indebtedness, which we'll get to in a second. But if it's used for any other purpose, it's no longer deductible. Right? So I'm going to Aruba, I'm paying for college, and it's not deductible. Right? So remember, acquisition indebtedness includes purchasing, but it also is improvements. See, that's the problem with this term. It should be acquisition and improvement indebtedness. So if I refinance my first position that was for acquisition with a HELOC, I can take it. If I use it to put a deck on or some other improvement, I can take it. It's a very important nuance, but the IRS is going to be very interested in this because people have taken advantage a long time. So it's very important. So assume a HELOC is not deductible until we get other information. It's very important to make sure. Okay? So mortgage insurance premiums are still deductible because legislation was recently passed a few months ago to make sure it was. So that's important too. People say, oh, it's a negative, but we can deduct it. Right? So another positive selling point for you in case it comes up as a negative. Right? Okay, now let's talk about the impact of these SALT deduction limitations, right? So everyone's worried about the state and local income tax deductions and how it impacts things. So I have a couple of good case studies here. I'm going to take you through it. And this first one is a good potential client for real estate agents. It's a couple making $100,000 and they're currently renting. They have 2 children, right? This is someone we want to buy a house, correct? So let's look at this. So there's 3 columns here. The first column is 2017 taxes calculated. And the middle column is 2018 tax, also calculated as renters, no itemization, didn't buy a house yet. And the third column is if they bought a house, okay? So let's take our time and we'll go through this, because this is something where this should help you with the logic, because you meet people like this, right? So let's take the first column. We have $100,000 of income. We have no itemized deductions because they don't own, they're renting. We have a $12,700 standard deduction, and we also have exemptions, 4 of them that total $16,200. So my taxable income is $71,100. Very simple, right? So the tax on that is $9,736. So let's skip the rest of that column for now. Let's go to the top of column 2. Same situation. They didn't buy yet, so this is apples to apples, tax code 2017-18. So let's look. Oh, look, they get a $24,000 standard deduction. Seems fantastic, up from $12,700, but we lose the exemptions. So our taxable income is actually higher. Our taxable income is $76,000, almost $5,000 higher. Seems like a disaster, you'd say logically, but it's not. The tax is $1,000 lower, even with a higher taxable income. That's because of a lot of other changes that were made separate from the SALT deduction. That's why I did this. So look, you have no itemized deductions, and they're saving a tremendous amount of tax. $1,000 off of $9,700 is better than 10%. So, okay, so that's $87.39. So now let's go to the top of the column number 3. This is where they bought a house. Could that be okay or worse or better? So they have some pretty, I put some pretty standard itemized deductions for what they would buy, and that's $26,500, including some charity. Now if you notice, we take the $26,500 itemized because it's higher than the standard. They still don't get exemption, so their taxable income is a little bit lower than it was rented. So their taxable income is $73,500, down from $76,000 as a renter, but it's still higher than in 2017. But I'm saving $1,300. I go from $97.36 to $84.39. Now let's go a little further though. They have 2 children that are eligible for the child tax credit. So in 2017, their net tax was really $77.36. But look at the second column. Those same 2 kids now get $2,000 each. So really, the net after-tax savings is $3,000 for this couple. So, as I tell everyone, can I sell the house they would have gotten or a better house? No doubt about it. And this happens all day long like this. So everyone that's renting has a situation, even without the child tax credit, so I broke it down. Even without the child tax credit, they save money. They can buy a house they could have had or better. But with a child tax credit, imagine that someone had 1 child. That was like an extra $3,000 they would have had in their pocket. That's a lot of money every month, right? How much more of a mortgage can I get by $250,000 discretionary income, right? You know better than me. So now let's look at the third column. It follows through the same thing. It's even better for them. They bought a house. So this goes. Why this is important is because we talked about it before. That everyone says that the SALT deductions are intrinsic to the value of the house. But it's really, so we have to change that conversation, which I've been trying to do constantly, is that no, we have to look at your net after-tax income. How is the full package of the Trump tax update affecting everybody? So if I looked at this and said, you have $3,300 more per month, per year, that's where we are with the new tax plan. So that's we have to start change the conversation. Because people want the house they want to buy, can they afford it? So the tax plan overall, even with limitations, is not hurting people. That's the most important thing, even if you're a break-even, which is rare. So this is a really, and I'll send you the slides if you want, because this is a lot of realtors keep this at their desk, as an example. It's a really good one. So let's go on to the second example. Is everyone's okay with that? Am I taking too much time, Tim?
No.
Okay. Are you okay? All right. So there's a family of 4, and they're married again, and they're making $230,000 a year. They already own a house. So let's see, how does it affect them now? Apples to apples, same exact information, how does it affect them? So we're going to look at them, $230,000 of wages. We have state taxes and property taxes of a total of $18,200, right? $9,900. Now, that's going to be limited, as we talked about, but let's go to the bottom of this column. We have itemized deductions of $33,200. We still have 4 exemptions at $16,200. My taxable income is $180,600. Make sense to everybody? Very simple. Tax of $37,453. So let's go to the top of the next column. We have the same exact income, but look, my itemized deductions are only $25,000 because I've lost $8,200 of the property tax and state tax. They're only 5. They're limited to 10 total. 5 and 5. I don't have any exemptions anymore. This is a disaster. I've lost, right, if you look, my taxable income is $25,000 higher. Look, this is real numbers. And my tax is only $325 more for the whole year. It was hard for me to get to a negative. I wanted to show red. I really worked at it. But that's how, look at that difference. So you couldn't have, I have $8,200 of itemized. I'm losing 25% of my itemized deductions, right? $8,200 off at $33,000. and I'm still breaking even. That's because one major thing that's changed is the alternative minimum tax, which is gone for a lot of people, but that doesn't matter. Tax is tax. So that's a real, so if you had a couple that was looking to do something or buy a house and said, listen, it's that the new tax law is only impacting you less than $30 a month, I think I can sell them the same house. I could, and I'm not even a realtor. Right? Right? Make sense? So it's this kind of thing where you say, oh my God, that's why it's good for me, because I get a lot of business from you guys sending people to me. Because their current accountants don't really know what they're doing, or they should be doing this, and so people come to me, they pay me for the hour and a half, and then I can analyze, say, yo, this is fine, and I do a certified projection, and then you guys get them back the next day. And they're all happy, and they're ready to go, and then the mortgage people, we have to deal with underwriting. Well, underwriters are very sweet people. Underwriters are caring, loving, open to change. A lot of hope and light in them. So the problem is, we have to, there's such a big difference trying to get underwriting to see what's my current 2018 situation. They want to take 2017 and 16 and average it. I understand that, but there's such dramatic...
For self-employeds.
What?
For self-employeds, not for W-2 wages.
Right. So we can, if they're open, there's some other... All right, no, Wells is good. So we just have to make sure that we need to analyze the current situation and get underwriting, hopefully, to see that as part of their of what's affordable for them, as opposed to just doing a crazy, easy average. Make sense? But we call time with that. But now look, what's better about this, they have 2 kids. In the first column, look, they get no child tax credit because they made too much money. Right? They're 0. But they made under $400,000 as a couple, they're getting $4,000 as a child tax credit. They're saving $36.75. They're saving $36.75 even though their taxable income is $25,000 higher. Even with 1 child, right, they're saving $16.75. A lot of people buying a house make less than $400,000 and have a child. So that $2,000 is huge. A lot of money, right? Even on a tax, it's even a tax of $37,000. This is the kind of thing we do all day, and it's very important because we want to give. I want to give the client confidence, total confidence, then give the lenders confidence, and so you guys have the easiest job in the world. Find a house you want and the price point we can pay for it. That's what I wanted you to get to, like it used to be in the heyday when we had pick-and-pay loans and buy 20 acres for $15 million. It's only $4 a month until it's not. Right. So anyway, so this is a quick This is another same family, $500,000 couple. Same thing, 2 kids. Now take a look at their itemized deduction, $75,000. They made too much money to get any exemptions. That's why it's 0. They phased out of exemptions. So their taxable income is $425,000. Let's look at the next column. They lost $35,000 of itemized deductions. I couldn't have made it worse. $35,000, right, off of a total of $75,000. Right, almost half of their itemized deductions are gone, and they're still saving $15,000. Again, so even higher income people, right? So you're seeing that it's not the death knell. And let me explain what happened. So yes, if you look at the SALT deductions in a vacuum and said, yes, if I'm limiting my other example from $18,200 to $10,000, is that going to negatively impact the tax? And that's what the leftist media does. Yes, but no, we have to look at the whole plan. But imagine what happened with the tax plan is that all the rates, let's say if we have a tiered system, we have rates going from 0 to, used to be 39.6. So let's say that all of those rates were reduced by 3 points. Okay, well, everything being equal, I'm going to have to pay less tax. Right at my 10% bracket, it's now my 7% bracket, right? But, so that's one thing that happened, and I'm simplifying it. But then also what they did is they moved the brackets over. So when you got into those new rates, right? Because remember you were in a tiered system. I make $100,000 as a couple, I'm up to the 15% bracket, right? As we make more money, we pay more tax on that money. So the rates are lower, and when we get to those rates, it's longer. So that has to reduce the tax too, right? If I stay in 15% bracket, another $50,000, right? And not go up to 22, then of course I'm saving money. So that's why this can happen. So everyone shares in the benefit. Okay, am I making sense?
Yes.
Yes.
Yeah. No, I'm sorry, Chris. This was wonderful, but we have an appointment back. I'm so sorry.
No problem.
But excellent presentation. I love it. Yeah. I think we need you to come back into company presentation.
Okay.
Yeah.
Well, it's good to see everybody.
Yeah. No, we don't need to break it up. We just have to go.
Thank you.
Another.
Now we have this last example is same couple, it's $1 million, and simply they've lost 105,000 of itemized deductions, but they still save up to almost $9,000. So it's very hard to find a negative. That's the point you see. We'll see real numbers, and like I said, I don't have to guess. You know, we have the law, right? So now let's talk quickly about investment properties. So none of those limitations affect rental properties. I have no limit on property taxes of any kind. That's the big question. So it's only with the residence and itemized deductions that has an effect. Your Schedule E investments, your partnerships that are real estate investment, there are no limits on that. Very important to remember that. So a lot of agents think it does, and they're telling people, oh, they're getting questions, right? Oh, I have limits on property taxes, and they say yes. With an investment, it's not true. So it's cutting deals off that don't have to be cut off because people have misinformation, right? So let's talk about the pass-through tax rates, because this applies to you. This is a very important thing for you guys, is that some taxpayers can get up to 20% deduction on what's called qualified business income. And that's your net income as a Schedule C, realtor. And so that would mean if single people, and there are some limits, but I want to talk about the benefit of it. So there's single people that, if there's certain people that make a certain amount of income, if it's less than $157,000 net, they're going to get a 20% reduction off of their taxable income. Let's say you make $100,000 net from your real estate practice, right? On your Schedule C. You're only going to pay tax on $80,000. That's how simple that is. It's fantastic, right? So see, $80,000 only. So married people, it's a higher number. But suffice it to say, across the board, real estate agents should get a great benefit from this if it's handled right on the tax return, right? But it doesn't include self-employment tax. Everyone knows you pay your self-employment tax, right, on top of your income tax. So they're not going to give you any Social Security or Medicare break. So if you have $100,000 of income, you're going to pay $100,000. You're going to pay self-employment tax on that. It's only on the income tax portion, okay? Everyone gets it? And that was in red, so it must be important. New Jersey Tax Amnesty is coming, and that's coming probably November. It's a 90-day period ending January 31st, 2019. This is important for everyone here who has a client, or they have someone who hasn't filed and might have money owed, or they have prior years they've been worried about. So
Oh, sorry, I just have a question. Do they normally do that?
Oh, yeah, every couple of years they do it.
They do, okay.
Every couple of years.
So exactly what is, so.
Or my brother.
All right, so I'm going over it. So you could pay 100% of your tax and only half of the interest and zero penalty. So an example, I have money owed from 2014, I haven't paid it yet, and things are accruing in the crazy New Jersey system, and I owe $10,000, but really it shows $20,000 on my schedule of liabilities. Well, all of that can go away, and you're just going to pay half of the interest, and no penalty, and if you pay it off within the 90-day period. Let's say you have old tax returns we need to file in New Jersey. Well, I'm only going to have to pay half the interest, not penalties for years. So it's anybody who has an old tax debt or his prior years should be calling me to go over it to see what the benefit. I probably have 20 clients right now where I'm doing multiple year tax returns. Finally, they're coming out of the shadows just so we can save this money. All right, so it's important to alert people, and everyone should get my blog posts and my podcast. It's really good information that everyone can use. So non-filers are welcome, like I said. Even current audits can be considered. You might be under audit arguing with an agent, and well, maybe getting rid of the penalties and half the interest might be worth it. Just say, yeah, I'll settle it, and make it go away. So even if you're currently under audit, it doesn't reduce your taxes, it just reduces your interest and totally removes your penalties if you do it right, okay? Very important. It's not a tax reduction. So let's go over the short-term rentals now subject to sales tax, one of the last things I'll talk about. So this is brand new law. It's very important for any client that has a rental property, especially if they collect the rent themselves. All right? So what is a short-term rental? 90 days or less. It could be a room in a boarding house. It could be anything, 90 days or less. When it starts October 1st, so the last quarter of this year, if you have a rental property you're renting starting that day, the sales tax has to be collected if you're collecting the money yourself. Okay? What's a transient rental? It's 90 days or less. Could be a single room or entire home. Even if you're renting a room in your house to someone, yes.
If you have a rental property that you already rented, okay, and you're saying that at the 3 months before the end of the year, okay, any rent that I collect on that property property is not gonna be taxed. If they
Well, it
pay
depends, I
directly
mean, if you have, is it a 90-day term of the lease?
No, it's a year.
Well, no, then it's not subject to tax.
Okay.
It's 90 days or less term, so if you're let's say you're renting a house to someone month to month with no lease.
Right.
Well, the term is 0. I don't have an official term. So that means I'd have to collect sales tax on that. If I'm renting it, technically, if I'm renting a house somewhere, I need an official document that says it's 91 days or more.
Okay.
Or else the state's gonna come in and say it's sales taxable. Very important, right?
So it would affect more like summer rentals.
Right, exactly,
Yeah.
right.
December.
Well, you got it, I'll call you.
All right, thanks.
So it doesn't apply to things like hotels and motels and things that already have a tax, or they're already grandfathered in, right? They already have their own taxes and fees. So they created a new term called the Transient Space Marketplace. This Transient Space Marketplace is something like an Airbnb. That's someone that lists it for you, collects the money, will collect the tax and send you a check. That's very important, that they do all of that, including taking the money, which I think is, like we talked before, which is a very important thing. Or a similar vendor, right? They're required to collect the tax. So it's going to cost your clients or your tenants more money now, right? No matter what. So now, if it's an important distinction who's not a transient space marketplace, right? So someone that charges an ad for your place is not a transient space marketplace, meaning you have to collect the sales tax, right? It's that kind of thing. A service that charges an upfront fee for placing an ad does not collect the rent from the customer. This is the important part we talked about, right? So it's not considered a transient space marketplace. So this means, the above means the landlord must collect the sales tax, all right? And so, but transient space marketplace does collect all the rents from the fees from the renter and remits a net amount to the property owner. That's going to be the key thing here. We talked about it already. Is that I have the State Division of Taxation took down the website because so we need to get clarification. Who takes the money? I talked about it before. If a real estate broker that does everything, and but the check comes to me, and Chris Whalen, and I deposit that check, and then I give a commission to the broker. I think that's going to negate that the sales tax isn't collected, right? So all of these potential taxes could be involved here. Sales tax, the occupancy fee, and some of the regional fees, right? So if you need to collect the sales tax, you need to go on the New Jersey Division of Taxation and do a New Jersey REG. And you have to register, so you're going to collect sales tax. And there's all these rules for that, so we're doing that for people too. So there is an exception to this. If a real estate brokers the transaction, and where the key is picked up at the realtor's off-site location, no sales tax is required. So that's where the real estate lobby did a good job, and they gave the real estate brokers an edge over Airbnb. Everything else being equal, right? Now have an advantage. Airbnb must charge sales tax. Real estate brokers do not. So it gives you guys a 12% advantage. Everything else being equal, right? That's one of the thoughts. Fees paid to a listing agent, right? A real estate broker. The broker is better consumer bet because the 11.6.25% fees do not have to be collected. But the key question is that they have to take the check, like Airbnb gets the money and gives me a net check. So that's where I wrote to them and said, no, you can't leave it out there because real estate brokers could say, I'm doing something, I'm brokering it, but I'm sending them the check too in their name. So we have to have a line in that says, no, you have to tell everyone, do they have to collect the check or not? Is it written to the broker or written to me? If it's written to me, I've done a lot of auditing a long time, but whoever gets the check written to them is the one doing the business. Very easy, right? So I want to talk about cloud storage for a second. I often say, I love clouds, right? But I try to put things in the clouds and it just never stays. So I say that because it's not secure and it's vaporous, and a lot of your tax preparers put your information in the cloud. Every year after year. It's not safe, it should not be there, it's identity thief stream. Everyone should call their tax preparer and say, you don't put my stuff in the cloud when you key it in, right? Because it's not safe. It's not, no matter what they say. So we need to ask your accountant, and if they do, say you need to change, because I have a system where it's secure in my office, it's not even on the internet, I can do tax without it because I know the harm it can cause. CPAs are hacked every day on these servers, and they go out of business, and they're paid off. Happened to a guy in Eatontown. And then he says, everyone says, how come you retired so early? You know, I just wanted to go sailing, you know, I got it. So that's an important thing to really check with. And let's say you want to use the same prepare, well, they don't need to keep all your years out there, right? There's years and years and years of your tax returns. Why would 2014 still be out there? It's identity thief's dream. All you, your kids, your socials, your birthdays, your address, mortgage information. I mean, there's no better, you know, cache of information than all your tax information. So I urge everyone to check on that, and if they say it's secure, it's not secure. It's cloud storage. So remember my picture. Say, wait, no, that's not secure. It's terrible that they use that word. I would never have used cloud storage and say that it's secure. Right? It doesn't make sense. So here's my ending. I hope you found this worthwhile. Make sure you have my contact info. Give me one of your cards, and any questions. Yes, ma'am.
I have a quick question. Like when I go to my accountant, and I am looking for a new account, by the way, I'm going to contact you, but he always goes on, when I walk in, he always goes on and says, oh, it's the same as last year? Is my information in the cloud, or is that in his private computer?
You know, I don't know, but most likely it's in the cloud, because the cloud, it's much cheaper to get software that's all shared and distributed, right? So I traditionally get CDs, I load, you know, so my software costs more money on purpose because it's more cumbersome. Whereas if I had shared and distributed, right, if I'm just going on, most accounts have like a terminal, you would think, where it's just virtual, where, oh, I'm in the cloud, even the program's in the cloud. And some of these accountants send everything over to India.
Oh.
They scan everything, they send it to India, and those people are on a terminal putting your data in. So we want to make sure, and I tell everyone you should fire your tax preparer if they use cloud storage for your tax data.
I'm going to text him right now.
Exactly. And they might say, don't listen to Chris Whalen, you know, and he doesn't know what he's talking about, but I've been doing this a long time and on a tech a long time, so, you know, I would love to debate anyone if they say I'm wrong about this. So it's okay. I'm going, you have a tech degree? You know, I have a tech degree, so. So anyway, but I appreciate everyone coming, and
Thank you.
a good group, a big group, a small group, and it was Susie?
Yes.
Susie's here. Susie got the tail end of it. And yeah, but it's great to see everybody. And Don, it's good to see. Thanks for the other day getting me in here so I could check. Glad I got to check everything, so it made it simpler now. I check out the room ahead of time. I bothered Donna.
And you know what it is? It's word of mouth. One tells the other, the people that couldn't make it. We
I
tell
hope so.
how inspiring and
You know, come on, give me a break. You know, prefer me. And because since my parole, I've turned my life around. So you know, but thanks everyone very much.
Thank you.
Very good.
Thank you guys for coming.
Thank you.
Thank you.
Thank you.
The best crowd I presented to today.
Oh, it is? Well, make sure the most expensive one, right? You're welcome. Would he take the less expensive one? Let me know if there's any questions on any of the information.
Yeah, no, definitely capture
Thank you. I try to take.
And when I do, I'll tell you.
Yeah.
You do
That'd be
everything,
great.
so you know who's calling and.
Yes. And it's a federal authority. Alexandra, has your contact, qualified yet, your general client? So, what, huh? Oh, you don't know? We were expecting one. Oh, yeah, no, I know, we were expecting one. Right. So, it's okay. There, I got that, came through as well. Yes. Yes.
So Donna, just call me, okay? We'll get together. All right, it'd be great.
For sure, Chris, absolutely.
It'd be lovely.
Thank you.
She doesn't think she's getting enough back.
I think I'm in the cloud. I want to be up in the cloud.
Yeah.
I want to be on